Okay, well, we'll just wait a moment just to let everybody start and enter the session. I'll just give it a couple of seconds. Okay. All right, it's looking pretty good now. Okay, well, good afternoon, ladies and gentlemen. My name is Hugh O'Grady. I'm GSFM's Key Account Manager for Western Australia. And on behalf of all the team at GSFM and also Munro Partners, welcome to the webinar today with Munro's co-founder and CIO, Nick Griffin. First of all, I would like to start by saying sorry we couldn't be with you today in person. We'd dearly love to be with you, catching up face to face, but due to the COVID situation in Melbourne, unfortunately, Nick and I are stuck here and unable to make it across the Nullarbor to Perth. Now, hopefully the situation won't stay like this for long. We are quite hopeful that things will improve, and in the near future we can make it across. And I am really hopeful that we can make it across by late August or early September. So I'll certainly keep you posted. I would also like to start by saying thank you all very much for your support. I must say we've had some great supporters of Munro in WA, and really from the very early days as well. The Munro Global Growth Fund in Australia just went through $1.3 billion in funds under management across the 3 Munro vehicles. And again, just on behalf of the teams at GSFM and Munro, I would like to say thank you very much. Now, the 3 vehicles I mentioned, first, we have the flagship long short fund, the one that most of you would know, the Absolute Return Fund. We also have the ASX quoted vehicle of the Munro Global Growth Fund, which is the stock code MAET. We launched this back in November last year, and this vehicle is really for those investors who wish to access the fund via the ASX. This is an active ETF with a market maker to ensure it trades at NAV. And the third vehicle is the Munro Concentrated Global Growth Fund, which is effectively the same process, but is purely long only and unhedged on the currency. All have recommended ratings with both Zenith and Lonsec. So for investors, the last 16 months have certainly been a wild ride. And for the Munro Global Growth Fund, with its absolute return focus, where it is all about protecting investors' capital first and generating a double-digit return per annum on a 3 to 5 year view, well, that actually really summarizes the year that's just been passed. The risk management tools that the team had fine-tuned over many years were in place and did an excellent job in the aggressive sell-off in March. And then combined with some great stock selection throughout 2020, led to a calendar year where the fund delivered over a 40% return. Now, leading us to today, the performance now sits at, since inception, just over 16% per annum. So since the back end of last year, we have witnessed a reopened trade and the resurgence in the value versus growth, I suppose, situation. The question is really about where to now. Nick has prepared a short presentation, but we'd really like to keep this interactive. So the format will open up to a Q&A where I will ask the major questions I'm coming across. And then after this, we'll go to your questions. So please do ask any burning questions throughout the session in the box at the bottom of your screen, and I'll make sure we address these. So as I said earlier, I'm very pleased to be joined by Nick Griffin. Nick is a co-founder and the Chief Investment Officer at Munro Partners. Before we get going, I'd just like to say, Nick, welcome.
Thanks, Hugh, for having me.
And Nick, I'll hand over to you now. And if you'd like to just get started with a quick business update, and yeah, we'll hear about your presentation, and then we can go into a Q&A. Thanks.
Thanks, Hugh. Appreciate it. And look, as I concur with Hugh's sentiments. Just so disappointed that we can't actually be there. And if you could lend us your premier or someone to run this state at some point, that'd be really helpful, because then we could actually get out of this mess. But I think we will be back there, Hugh, hopefully in September when Perth is hosting the AFL Grand Final, by the sounds of it. So look, from that point of view, thanks very much for taking the time. I do hope we get there. I know you've probably been on a lot of Zooms. They're probably getting a bit tiresome, so we'll try and keep this one short and interactive. So I'll give you a quick business update. As I said, I'll quickly deal with maybe a market outlook and how we're positioned to deal with the problems of the day and what we think might happen in the future. And then as Hugh said, please dive into the Q&A. So just in terms of a quick business update, just to remind everybody, and I know some of you have seen this before, but look, we are at Munro Partners, our purpose for being is really to be your global growth manager. We set the business up in July 2016 to really be that global growth investor that Australia didn't have at the time. So at the time, you had a lot of global value managers in sort of Platinum or Antipodes or to a certain extent Magellan, but there was no one really taking the other side of the coin, being growth. And so that's what our goal was to set up. We started, as Hugh said, with the Munro Global Growth Fund. We then launched the Munro Long Only Fund, and we've since made the Munro Global Growth Fund available on the ASX under the code MAET. And I think the real key to that is that it really fulfills the purpose of what we were trying to do, which is, you can literally go onto the ASX today and buy a share in Mate, and tomorrow you wake up and you'll own what we think are some of the best growth companies in the world today, whether they're Taiwanese semiconductor foundries or Dutch lithography companies or Danish wind turbine manufacturers or US software companies. And that we think fits into your balanced portfolios that you're trying to put together. We obviously started the business with just $20 million and we've actually managed to get to $5 billion in just the space of just under 5 years. And look, partly that strong performance, the fund has done well, with a 16% per annum return since inception. But that's actually also matches our 10-year track record previously, which also compounds at roughly 16% per annum. So we actually have a 15-year track record of compounding over 15% per annum with this process. Unfortunately, it's not a straight line. It never is. I wish it was, but it's not. So partly it was good performance that helped us get here. Importantly, it was very much Grant Samuel and the great work they've done distributing our product around Australia and also in Canada. But lastly, I think it was this key point that I'll keep coming back to through our presentation is that people began to realize that they needed global growth equities in their portfolio. Their businesses or the companies they were investing in were being disrupted by these big offshore disruptors, and they needed access to those ideas. And we managed to bring it in that absolute return format that people were comfortable with. And I think that's why people chose our product. And so for those of you who have, we're very thankful. And I think that's a quick story as to how we've got to here. In terms of the team, just really quickly, these are the Munro Partners. We're all based here in Melbourne, Australia. The business has continued to grow. We are a partnership, so we do actually, earn the profit share from our business. We control roughly 75% of our business today. I was telling someone today, when we started the business, I sold all my personal stocks and all my money is in the fund. And for all the equity partners, we actually tell them that they're not allowed to own personal stocks anymore. And so that's really how we decide to run things. We've just taken out some new office space here in Melbourne. And if you ever decide to risk coming over here, we'd love to see you. But that space allows us is going to go to 25 or 35 people. And we're going to continue to invest in our business, mainly because we think we can still get better at what we do. And this is a process of improving our craft over time. And it's something that we hope to continue to update you on. That's the Munro Partners. And hopefully this will flick slides again soon. Yeah, so just to remind you on our philosophy, and I know people might have seen this before, but I'll just remind you very quickly because we're going to keep coming back to it in today's presentation. As our process, our 15-year process that we've been running now that has generated the returns, we have a very, very simple philosophy, which is that earnings growth drives stock prices. So we generally find that companies that make more money every year, we generally find their share prices go up. Sustained earnings growth is worth more than cyclical earnings growth, and the market always misprices growth and its sustainability. So these are two companies. I've actually been walking around the same two companies now for 5 years. So some of you may have seen me come around with the same presentation, same two companies in Perth over the last 4 years. One is Bank of America. That's the share price in the black, and the blue line is the blended forward earnings per share. On the left is MasterCard. That's the share price, and the blue line is the blended forward earnings per share. And so our simple observation now for 15 years is that this is a macroeconomic company and this is a secular or a structural company. We don't really know where the earnings of this company are going to go because it relies on the macro. We have a view, we just do not have an edge. Our view is as good as the other 5 Zooms you've been on this week. But on the left here, you can see MasterCard that's benefiting structurally from the shift from physical to digital cash. What's amazing is everybody knows this, but they're incapable of pricing it in. And they can't price it in because it's a structural trend. It doesn't mean revert, it actually accelerates. And so our process is really designed to find these, what we call S-curve situations, over and over again, because that's really what's going to generate the returns that you're looking for. Why do we do this? And why do we organize our world this way? Is because we just think that most people look at the equity market the wrong way. Most people look at it like, it's a case of being over or underweight certain sectors or over or underweight certain countries. And that seems great in concept, but it's just actually what's not happening in the real world. If you look outside your window, you would know quite simply that equities or companies is a game of very few winners and thousands of losers. This is just a great slide that was done by a guy called Henry Bessenbinder that really drives this message home to you, where he said, okay, well, let's just take a big step back and look at the US stock market over the last 90 years. And over that 90-year time horizon, there was actually 25,300 companies that listed. But what we now know, if you went and bought and held every single one of those 25,000 companies over the last 90 years, you would work out that 14,500 of them actually go to zero, so destroy value. So 60% of all companies don't make any value versus cash. The next 8,000 only do enough to offset what the other 14,000 lose, and you end up with just 1,000 companies. So 4% of all statistical observations generate the entire 40 trillion of wealth of the US stock market over that time frame. And the top 50 of those 1,000 companies make up nearly 50% of the wealth. So that's 50 companies out of 25,000 over 90 years make up nearly 50% of the entire wealth generated of the US stock market. So this is a game of very few winners and lots of losers. That is beyond doubt. And your job is actually to find these few winners. This just plots those few winners, those 50 or some of those 50, in life and months and annualized returns. And what's very, very clear to us is that macroeconomics has very little to do with this. There's always a big structural change, like the internet coming along here, with the new winners being Amazon, Facebook, and Google. And then there's just a couple of companies that benefit from it. There's a big structural change like software in the personal computing area, and a couple of companies that win from it. Or big box retailing with Home Depot and Walmart, or quick service restaurants and McDonald's, or aerospace and Boeing, or smartphones in Apple. It's always the same. There's always a big structural change, and then there's always a couple of winners. And so our job as your growth investor is really to occupy this top left-hand corner, identify the structural change, and then identify the winners. And I apologize if you've seen me say this before, but it's just really important to remind people of, because obviously there's always these cross currents going on. But this is our key purpose for being, and our key purpose for why we should or why we could fit in your portfolios. Okay, so I'm going to skip a bit of this. This is mainly investment process stuff. Please feel free to go look at it on the website if you're interested. But what I'll go to now is really a market outlook. Obviously, people are, can do the process in their own time. This is where we think we are in the market cycle, if that makes sense. And so when we look at the equity market, this is an analysis we do quite a lot to just sort of tell us, how cheap or expensive the market is. And so if you just take a big step back here, what we're showing you here is the equity risk premium of the S&P 500 over the last 20 years. And so when we say the equity risk premium, so if the PE of the market was say 20 times, it's actually 21 today, but for the simplicity of maths, it's 20. 1 divided by 20 gives you a 5% yield. So the equity market is giving you a 5% earnings yield today. If you subtract the risk-free rate, which is the US 10-year at 1.5%, you're getting roughly a 3.5% carry for owning equities today. No different to the carry that you might get on a rental property or some other asset class you look at. And so if you look at that 3.5%, that's roughly average compared to history over the last 20 years. So the market is effectively fair value. Got very cheap through COVID, got very cheap here through the financial crisis, effectively fair value, but it's nowhere near as expensive as it was, say, in 1999 down here. The big problem is, as I'm sure you're all saying, is here we're using interest rates, a risk-free rate of 1.5%, and back here we're using a risk-free rate of 8%. And so the market is pricing in these lower rates over time. And so the key question you have to ask yourself from here, or the key question we ask ourselves is what's going to cause this gap to close? What's going to make the market look expensive? What's going to make this analysis be wrong? And there's really three things that can change. One is that earnings could go negative. So if earnings growth went negative, the PE multiple would go up, and obviously that earnings yield would go down. And we think that's highly unlikely. We think we're in an earnings growth environment. If anything's earnings growth is going to continue to keep this equation driving forward, if that makes sense. So the earnings growth over time will continue to increase the equity risk premium of the market. So that's definitely not a risk in the short term, we think, unless, for instance, COVID came back. The second thing that could go wrong is the market can go up a lot. So if the value of the market went up a lot, then that would push the PE multiple up and push this down. And you'd end up back here in sort of 1999 levels. And that's probably the path of least resistance we see at the moment. But the big risk out there is obviously that the interest rates go up. So the US 10-year goes up. And this is really where this inflation argument comes from and where the tail risks are out there. And so again, I suppose you've got to look at this equation and say, okay, equity is a fair value here. What is the risk at the equity that interest rates back up a fair way? And again, we sort of take a big step back here. This is just showing you US nominal GDP over the last 50 years, effectively, versus the US 10-year bond yield versus the total debt outstanding in the world. And so what you can see here is you've gone from the stagflation period to the pre-crisis period to the post-GFC period to here. And so you're seeing this general slowing in growth globally and slowing in interest rates globally. And that's really because of a function of these three big deflating influences we've had in the world, which is debt, demographics, and mainly technology. And so from that point of view, these trends have actually been in place for a very long period of time. And so when we look at this recent backup in interest rates that we've seen here from 2000 to here, it's obviously caused the rotation that Hugh mentioned that I'm sure you're going to ask about. But it's actually not that different to the backup we saw back here when Donald Trump got elected. And it's not too different to the backup that we saw back here in 2012. And so what you've got to ask yourself is, as we move into a post-COVID world, do you think it's going to be an aggressively growing world? And my argument would be probably no, because none of these arguments have actually changed. The debt's actually got worse, and you're still actually going to have to pay it back. They're not going to print money to the never, or as much as people might make you think that. Even Joe Biden is talking about raising taxes to pay down some of these debts. So the debt situation is definitely going to get worse. The demographics is going to get worse. And more importantly, the technology progress will continue. And the last, I suppose, most important point is I don't think the world can actually deal with interest rates much above 2.5%. So if, rates were going to get back up to this sort of level of 6s and 8s because we lost complete control of inflation, then we've all got a much bigger problem. It's not just growth equities, it's everyone's got a problem, housing, equities in general. And so that's when our capital protection tools will become more useful. But our base case here is that interest rates sort of back up to sort of 2.5, and ultimately that enables this, sorry, I've gone and pushed the home key at the wrong time. Apologies. That allows, never should have tried to go backwards. That allows this equation to hold, and ultimately means equity markets are okay here. We see the tail risk, we see the risk, but ultimately on an adjusted basis, we think we're okay here. The last thing I'd just flag here about the technology angle, which is important to remember, is if you think about it, this actually happened in Australia, and it's also now happened in the US, and it's a fascinating insight into what happened through the COVID period. US GDP just got back to the same place it was in 2019, pre-COVID. Same things happened here in Australia. So your GDP's gone all the way down and all the way back up again. And so you're back to the same point you were in 2009, but you've done it with 7 million less employees. Sorry, 8 million less employees. You got rid of 22 million employees and you've only hired 14 million back. And so that huge productivity uplift has clearly come from what we all now know, which is that technology has helped us actually pivot to work from home or pivot to work online. And so those 8 million employees, as much as there's supposedly labor shortages out there, et cetera, are still not employed. And it's really more a function of how efficient and how productive we've got. And so those inflation pressures, I suspect, are not really going to come to bear in the months and years ahead, but obviously is a big topic that people are focused on today. Lastly, just in terms of a market outlook, I mean, this is obviously, lots could go wrong, obviously, and I think people like to talk about what can go wrong a lot, but it's important to stress that a lot can go right on the other side. And I think the one lesson I'd leave you with is that obviously we don't know what's going to happen next. If you asked me before COVID came along, I'll put my hand up and say I was the guy who thought COVID was a flu. It wasn't. But generally, in my experience, in my 20 years in equity markets that I've been doing this is the volatility or the VIX index for the S&P 500. Genuinely, when something really bad happens, like the tech wreck back here in 2000, or the financial crisis here, or COVID here, what generally happens is a lot of people spend a lot of time trying to predict the next big disaster. But in reality, you move through it into a really long period of low volatility. And we're starting to see the first signs of that today, as volatility's finally got below 20, starting to push down towards the 10s. And I think that's reasonably exciting for a medium-term view on markets. Okay, so that's a quick market update. In terms of current positioning, I think the important thing to remember from our point of view is there's nothing really in the macro tea leaves, at least at this point of stage, that's outside of what we've seen over the last 5 to 10 years. Yes, we've created this cycle, and yes, there's shortages, I get it. But nothing, on a 3 to 5 year view that would actually make us think that we have to actually change, our modus operandi. And our modus operandi is to look for these things, S-curves. I mean, this is essentially what's going to make us our money over the journey. I talk about them all the time, and apologies if you heard me talk about this before, but just to remind you, the S-curve will always beat the macro. So we can spend this entire call talking about macroeconomics, but if you actually spend your time looking at this stuff, you're a better chance for making money. And this is just a great example that we all know about, which is the mobile phone market. 2008 used to sell 1.6 billion phones per annum. By 2018, you sell 1.7 billion phones per annum. So phones don't grow. Ultimately, like the economy, they don't grow, and going forward, they're probably not going to grow. But smartphones come along, go from a 10% share to an 80% share. This S-curve of growth drives Apple's revenue from 27 billion to 250 billion. And along their way, they wipe out Nokia, Ericsson, BlackBerry, and a whole bunch of other losers along the way. Now, this structural growth ultimately made Apple's revenues go up 10 times, and its earnings go up 20 times, and its share price went up 20 times as well. And so from that point of view, it happens no matter what. It happens whether Europe goes broke. It happens whether Donald Trump gets elected. It happens whether North Korea launches missiles. It happens whether there's inflation or whether there's deflation. It's a wonderful structural earnings growth, and earnings growth drives the stock prices in the long run. If we look around today, these are the S-curves we've been following for quite some time. They've been very profitable for us because in many cases we've not got off them, because we recognize, at least on our maths, that they're not even halfway, and many of them are not even halfway through. And so the big one down the bottom here is e-commerce. E-commerce has taken 20 years to get to 25% of all retail sales in the world today. But we think that can continue all the way to sort of 40 to 50% of retail sales. And so obviously that'll benefit companies like Amazon. And there'll be new companies coming along like HelloFresh that are helping you move groceries online, for instance. Cloud computing, roughly 40% of all workloads are in the cloud today. But if you think about the workloads that still have to go to the cloud, we'd argue it's less than 20% of their TAM is penetrated. Microsoft is clearly a big winner here, but again, there are other ones coming through like ServiceNow and Free. Internet disruption, again, this is effectively what's underwritten for the last 10 years of my career. Digital advertising went from nothing to 50% of all advertising globally. This is obviously what drove Google, and then Facebook, and then Netflix. We also think, this disruption by the internet will obviously drive Uber in a very similar way into the future. And then lastly, digital payments, much more close to fully penetrated now. But the handoff from Visa to MasterCard is probably going to hand off to, the PayPals and Squares of the world into the future. And so in all of these areas, we're still very focused on them because we know that over the medium term, they'll still grow. We know that in many cases here, we're not paying that high a multiple for these companies. And so from that point of view, their earnings will grow and their share prices will follow it. And so from that point of view, as much as people are wanting to step off this stuff, we are sticking at least to the core of these areas today. The last thing we'd say just on technology really quickly is we don't think it is time to step off technology. And I think it's important to remember that what's actually driving here has got nothing to do with, mean reversion or which sectors you want to be or overweight or underweight. What's happening here is what's actually happening here in the real world, which is that computers are getting faster. They're getting dramatically faster. As Moore's law we continue to double the amount of transistors we can put on a semiconductor. And as computers get faster, computers can do more things. And so the simple way to think about it is, if you think about the internet used to just be able to send an email back in 1996. But as it gets faster, it can create search, and that creates Google, and there's 1.6 trillion in market cap. As it gets faster again, it gets on your phone, that creates Apple, another 2 trillion in market cap. Then the internet gets faster, you can send pictures, that creates Facebook. It gets faster again, you can stream video, that creates Netflix. It gets faster again, it moves the software into the cloud, which creates Zoom. It creates the video game companies, and then ultimately creates the peer-to-peer industries. And so this is obviously stuff that we already know about. But what's fascinating to think about is if you know Moore's law continues for another 10 to 15 years, there's going to be at least another 4 to 5 iterations of semiconductor density on the GPU and CPU. And so what that means in practice, in layman's terms, is that every computer in the world over the next 10 to 15 years will get roughly 40 to 60 times more powerful. And so that means this disruption will accelerate. It has to. You know, artificial intelligence and all these other things that we're looking at now means that more and more of these great companies are going to come along. And it's really our job as your growth investor to continue to look for them and continue to find them, and most importantly, find them at the right price. And so from that point of view, this is clearly one of the big structural changes of our lifetime, and it's important to still keep looking here because there will be more and more of these ideas into the future. I'll skip that one. But it's also important to remember that now that COVID is pretty much over, and I think, you know, yes, it could come back, but I don't think that global lockdowns are really going to be on the cards again in the future. It's important to stress that there are other areas that we can look at that we've invested in before that we think can be in the fund again. The biggest and one that we like a lot is always, and you've probably heard me talk about before, is emerging consumer. So travel, we think, does come back. Airbus has been back in the fund for a while now. Maybe short-haul travel outweighs long-haul travel. That actually helps Airbus because they don't make a lot of money on the long-haul airplanes, but they make a lot of money on the small ones. Luxury goods comes back into play, as does obviously drinks, as economies open up in the world. And so these are all areas that we've invested in before, and we still like them. High performance computing is semiconductors. We like them a lot also. They're really the shovels in that boom I showed you. They're much cheaper. You know, you're getting these companies in many cases at just 20 or 15 times earnings. Yet these wonderful structural growth trends behind them. And the last one is one we're probably going to talk a bit about today, and you might have heard me talking about quite a lot on videos and online, is climate. You know, if we look at climate today, we're really at the start of the big S curve. We're at the start of the decarbonisation of the planet. The opportunity is huge. We think, you know, it's going to cost anywhere between $30 and $50 trillion to decarbonise the planet. And it's going to create these huge winners. And we're right at the start of this. So, you know, as your growth investor, we're all over this like a rash. This is the bit we want to focus on the most at the moment. This is the bit where we see the most upside. So just putting that together, you know, these are the areas of interest where we see strong structural growth today. And so this is the fund as it was positioned at the end of May. We show this in our monthly and our quarterly, and it really sort of sums up what you're paying us to do, which is to identify these areas of interest, namely climate in this case, roughly 15% of the fund, 8 holdings, including Train Technologies. Digital enterprise is those cloud stocks I was talking about, 10% of the fund. High performance computing is the semiconductors, e-commerce, internet disruption, digital payments, and innovative health and in digital enterprise are below here. And so in all these areas, what we're trying to do is we're trying to build a fairly balanced portfolio. In each area, there might be a mixture of some high multiple companies, but there will also be a mixture of low multiple companies. And so if you think about the cloud, you know, ServiceNow is our high multiple company in here, but we also own Microsoft and Adobe, which are much more low multiple companies. And so what we're trying to do is build a fairly balanced way of approaching these areas of structural growth. If these areas do structurally grow, then that should equal earnings growth for our companies. And the earnings growth for our companies, provided we don't pay too much for them, should equal share price growth over the medium term. And that's what ultimately has driven to our targets over the last 15 years, and that's what we hope to do in the future. So what I'll do, I think that's a short introduction as to how we see the world and how we're positioned. And so I'll let you fire away with a few questions.
Yeah, thanks, Nick. Well, I think just continuing on with the themes then is, I mean, the climate thematic is obviously the biggest thematic in the portfolio. So Let's sort of delve into that a little bit. You know, where do you see the opportunities within this climate thematic? Can you quantify the size of the opportunities and maybe also maybe just at a macro level, but also at a stock level? That'd be great.
Okay, so thanks, Hugh. So just to delve into climate a bit more, and please do go online. We try to. These are our areas of interest. So coming back to what I said at the start, you know, ultimately, your job is to find the area of structural change and then find the winners. So we organise our world by these areas of structural change. They're all slightly different, have different idiosyncratic drivers, and so we organise our areas by these areas, and then we build a universe of companies that could potentially win, and then ultimately invest. In the climate area, why we like it so much is because it's sort of like every good revolution, you know, it seemed impossible and now it's become inevitable. And the reason why is because ultimately, you know, you've just had this wave of companies committing to zero carbon targets in the future, countries committing to zero carbon targets, even states committing to zero carbon targets. And in Glasgow in November, you're going to get every country in the world sit down and, you know, effectively the next Kyoto meeting where they're really going to try and line up and commit to long-term goals here. If any one country wavered, it doesn't really matter. We actually got into this area back in 2019 when Trump was president, because we could just see the states and the US were going the other direction. And so are the companies. So I think it is inevitable that decarbonisation is here to stay. So if you are going to decarbonise the planet, how much is it going to cost? So the Europeans have costed it for Europe. They think it's roughly 10 trillion US dollars. And so what we did is some complicated maths and added the US and the rest of the world and added that up to 30 trillion. So 30 trillion is really a bit of a finger in the air, but I've seen numbers as high as 50 trillion. And it's important to stress that it covers all these different areas. So it's not just electric vehicles, you know, it can't all possibly go to Tesla. Energy efficiency is actually a bigger bucket. Renewables is the same size, and, you know, transmission grids is the same size. So there's actually a big mixture of, you know, obviously exciting, innovative companies like Tesla here, but there's also a good mixture of, you know, quite frankly, boring companies or companies that otherwise were just industrials that now have this huge tailwind behind them that's going to stay with them for a very long time. And the key thing about this is now that we know this is going to happen, you know, we can effectively price it in. And to give you an idea, this is the amount of wind that's installed in the world today. This is where you're going to have to get to onshore to get to zero carbon. This is the amount of offshore wind that's installed today. This is where you're going to have to get to zero carbon. And so we're not talking, you know, this market size is going to double. We're telling you this industry is going to go up more than 40 times if you are actually going to hit these targets. It's exactly the same for batteries. You know, this is the battery industry today. This is where it has to get to. This is where it is today. This is where it has to get to. So, you know, talking 10, 20 times growth in an industry over a 10, 15-year period. So phenomenal exponential growth opportunities here. And if you look across the bottom here, you know, there's actually established players in these industries that have been there for a long time. They've just been waiting for this moment to come. And many of them are, you know, are quite frankly, reasonably boring companies. And then even if you look at electric cars, I mean, look at the one company that has priced in this upside, which is Tesla. The reason why it did is because last year, effectively 3% of all cars sold were electric. So 3% of every car sold, you sell roughly 90 million cars a year, 3% of them were electric. And of that 3%, Tesla had a 26% market share. So I think everybody on this call will agree, you know, 10, 15 years from now, probably 60% of all new cars will be electric. Maybe it's even 80, but let's assume it's 60. If Tesla holds its market share, it's going to sell 20 times more cars. It's going to make it by far the biggest car company in the world. And all the market's trying to do is not look at next year's earnings. They're just trying to say, well, if we know this is going to happen, let's go to 2030 and try and make some estimates as to how many cars Tesla could sell. Now, clearly, they're not going to hold that market share. And that's the debate. But that's what happened to Tesla last year. It priced in the upside because you could actually see it over a 10-year period. And all we're saying is, well, why should that just be exclusive to Tesla? That should happen in other industries as well, where we know this upside is going to come. And to give you an idea, you can actually take this even further into other industries like heating, ventilation, and cooling. So every building in the world, you know, 35% of the emissions come from its heating, ventilation, and cooling system. A good chunk of them, particularly in Europe and the US, run on fuel oil or gas. They're all going to have to move to electricity. On top of that, you could look at lighting, On top of that, you can look at things like indoor air quality. So there's and lastly, you can look at things like insulation. And so from our point of view, when we're looking at these areas, we're trying to find that company that's basically not priced for this opportunity, but the opportunity is going to lay out in front of it. And so Vestas Wind Systems was one of our better performers last year, so it definitely has priced in some of the upside. But ultimately, you're only paying roughly 25 times earnings for the world's largest wind turbine OEM, of which there are only 3 OEMs on the planet, and outside of the Chinese. And yes, there could be other OEMs come along or original equipment manufacturers come along, but it's important to remember that the bank won't lend you money if you get your turbines built by a non-recognized turbine manufacturer. So they're in an incredibly good position. Danish company today, roughly 50 billion US market cap. Another good example would be Train Technologies that we also own in the fund. So this is one of the big HVAC companies in the world. There's only really 4 or 5 that can replace a building's air conditioning system or heating system. And they've just got this long runway of growth in front of them, probably high single-digit revenue, double-digit EPS, as they effectively go around Europe and then the US, replacing all these systems to allow buildings to get to carbon neutral. And from that point of view, you're paying 30 times earnings. It's probably a little bit more than you'd like, but if you know the earnings will probably double every 5 years for the next 10 to 15 years, it's not a bad investment here. And that's one we like as well. And so that just gives you an idea of why we like it so much. A, because we're right at the start. B, because the companies are not priced like they have this huge runway in front of them. And C, because there's just so many to look at and to choose from. And so our job is to get here first and find the best ideas first, because that's what's going to drive the upside for our clients.
Nick, we're getting some good questions come through, but I might actually just double back to one of the key things that I suppose is on the minds of everybody at the moment. If you're an investor in growth stocks, is really, much has been made of this secular, this rotation from growth to value, and over the last 6 months. I mean, how far into this are we? How much further does it have to go? And what's, I suppose, for growth investors, what should they be doing?
Yeah, Ken. So based on this one, I'd argue, a good chunk of it's done. So I'd argue we're at least halfway. So tonight we have some inflation data coming out in the US. It's always a good sign when the entire market stops to look at an inflation figure that they haven't bothered to look at remotely once in the last 4 years. And so the entire market has stopped, effectively transfixed by this data point. It's fairly clear that there is going to be some more bad inflation figures. Anecdotally, we can all see it. You can't get. I know for a fact in WA, it's hard to get bricks. It's hard to get stuff to build your house. We all see that it's hard to get staff, etc. And so there is these anecdotal inflation prints. So you're going to get more bad inflation prints. I think that's pretty much a given, and I think everyone knows that. Then the question is how much is priced in. And so from that point of view, I'd argue quite a lot is priced in. And so I'd probably use this example of the one that I skipped before on Amazon. So this is just something that we would look at to tell you how far you're through this particular issue. So this is Amazon on the left. This is the EBITDA growth of Amazon over time, right? And I'm just using Amazon example, but a lot of companies in our portfolio would look like this today. And so we bought Amazon back in 2015 when the EBITDA was going to be 10 billion, and today it looks like it's going to be 70 billion. Now it's 70 billion. So EBITDA has gone from 10 billion to 70 billion because Amazon did a great job of positioning itself for this great structural trend of e-commerce and cloud computing. And so the EBITDA went up 7 times and the share price went up 7 times. So the company effectively perfectly followed its EBITDA. On the right here is is Amazon's EV to EBITDA multiple over that time frame. So the multiple of EBITDA that we had to pay over the journey. So we bought it at roughly 20 times, and today it's slightly more than that. And over the journey, it re-rated and derated and re-rated and derated and re-rated and derated lots of times. And it always did it because of something, nothing to do with Amazon. Amazon was just executing, as you can see on the left here. It was always because of something either Donald Trump said or Jerome Powell overtightened rates, or now it's the inflation argument. And so what we know is, that this can only happen for so long, right? Because we know on the left here, our model tells us that E-commerce still has a much bigger runway to go, as does cloud computing. Amazon's perfectly positioned, so it should be able to position itself for this tailwind for the EBITDA if we go from 70 billion all the way to 150. And so from our point of view, yes, Amazon could derate a little bit more. We could get it at the rock bottom price we bought it before, which would be about 18 times EBITDA. So maybe there's a little bit more of this to go. But in the end, the earnings growth will shine through. It's inevitable. The company can't keep upgrading earnings, and the share. All that's been happening here is the earnings have been going up, and the share price has been going sideways. So the multiple's been going down, but eventually the multiple will stop. And so from our point of view, if we look forward in the next 5 years, if I'm reasonably confident that's going to 150 billion, then if the multiple stays the same, I'm going to make 100% of my money over the next 5 years. If the multiple drops to 17 times, I'm going to make roughly 75% on my money. So the risk reward still looks very good. And so in terms of timing, my point would be is it's sometime in the next 3 months that ultimately the earnings take over here. And so our job as your growth manager is really, and we've done a little bit of this already, is just to be a little bit more respectful about valuation, which we've done when we build the portfolio. We have sort of cut the tail on some of these real high multiple stocks that did well for us last year, and just be a bit more respectful about valuation and just let these earnings growth come through, because the earnings growth will ultimately drive the stock price. They can't derate forever. The other thing to point out is that, as you get closer to September, the reason why these companies are derating is because they're cycling, tough comps. But as you get closer to September, this becomes a problem for the cyclical stocks because, growth cannot possibly be as strong next year as it was this year. So they start to cycle tough comps. So I think it's sometime in the next 3 months, we might have got there already. The last thing I'd just say on this, and I think this is an important, and I suppose, that, again, I just come back to this slide. Just don't get too hung up by the narrative, okay? So every year there's always a narrative. There's always a narrative. This year it's inflation. Last year it was COVID and the US election. I literally spent the entire year talking about the US election and nothing happened. The year before that it was the trade war. The year before that it was Donald Trump getting elected. The year before that it was Europe. The year before that, it was coming out of the financial crisis. And so all these narratives are happening the whole time, but in the background, there's companies just executing like this on the left. And your job is to try and ignore those narratives, find the companies that execute, try not to pay too much for them, and it'll be fine. That's why the S-curve always beats the macro. And so from our point of view, while I can't tell you the exact timing, I can tell you that it will eventually happen because earnings growth drives stock prices in the long run. It always does. It always will. As long as you don't pay them too much for them, it'll work out.
Oh, that's great, Nick. Thank you. Now, we've got a great question just on shorting. So has your approach to shorting changed because of the GameStop debacle and the targeting of shorted stocks by Reddit and online forums? How do you avoid the risks associated with this?
Yes, a great question. So this is the net and gross exposure of the Munro. So now we're just talking about the absolute return fund. So just to remind everybody, we run an absolute return fund and a long only fund. So we're just talking about the absolute return fund here, which has the ability to short sell, has the ability to buy a put option, has the ability to move the currency, has the ability to hold cash. Both products do the stuff in white, which is ultimately just pick stocks. So in the absolute return fund, this is the net and gross exposure over time. And down the bottom here is the short selling side of it. And so that's the gross at the top. The net sort of stays roughly 80%. You'll see these big drawdowns here in 2018 and again in 2020. And that's not us selling the whole fund. That's just us hedging the fund for the difficulties. And I'll show you how that worked out in a second. On the short selling, what you'll see is, it's not a big part of what we do. It's usually roughly 10 to 15% of the portfolio. We've generally found that you need to be quite, it's a bit, my old boss used to make this joke, and I think it's a really good one, which is that, shorting's a bit like your left foot. You kick better with your right, but sometimes you're going to need to kick on your left. And it is very helpful, but you do want to use it in a good timing situation. And so you can see here going into COVID, we were much more aggressive with shorts. Right now is not the time to be aggressive with shorts, but at some point it will be again in the future. The GameStop debacle is not great. It generally means you just can't short anything with a market cap below $10 billion, $15 billion. We definitely wouldn't get in the way of some of those things, and they're not things we would normally short anyway. So we're still shorting big cap companies, yes, because they can't be pushed around by the Reddit crowd. Well, they're too big to be pushed around by the Reddit crowd, at least for now. The other thing we'd say is, a lot of the times we are, particularly here and here, shorting futures. So some of these positions we're just shorting NASDAQ futures to protect against the fund through some of the volatility we've seen recently, and shorting ETFs. So those are other ways that shorts can still work for us without doing specific single shorts. But it's important to stress that it is something that we're not doing all the time. The last thing I'd just say on this, just really quickly on the shorts, since I was there, this is that March quarter for COVID, and that is the December quarter. And so short selling, that's how much we lost on the long book in the March quarter of 2020, and that was the December quarter of 2018. In both cases, the short book helped out. In both cases, the option book helps out, and many times currency helps out. So they are quite useful things to have shorts for these difficult periods. But just important to stress, this was obviously a very good period for capital protection tools because the market fell so quickly. This was back in 2018 where we had much more of a rotation. And this is a bit more like what we've been through the last few months here as well. And so the tools are helpful, but they're just not as useful as they are as when, the whole market's falling as far as what they are. And so it's just important to manage expectations as to when these tools are useful and how they can be used. Obviously we have them and everyone else doesn't, which is great. And we have good experience with using them, but the outcomes can be different depending on the scenario.
And I suppose to that end, and I'm probably trying to address a couple of questions that have come through in the Q&A. So I hear that there's talk of the market needs a correction. Talk of a 15% correction in the near term. What sort of risk management tools do you have currently in place to protect against this? And also, what else can you do with a further rotation? If we see this rotation continue. Inflationary concerns continue to come through, or more of a rotation to value and recovery stocks. What can you do, and what have you got in place at the moment to try and I suppose navigate these conditions for investors?
Okay, thank you. So the two things we have done, this just shows you the fund as at the end of May, and so I suppose if you look at this is our gross exposure and this is our net exposure. What you can see is that, we haven't really changed the top of the portfolio that much. The top 5 positions have been fairly similar for a while, but you will see we are running a bit less risk. And so the first thing we've done to deal with some of this is if you look back here, we were running exposure much higher. We are running, just generally a little bit less risk through this period. We're not getting rewarded for taking the risk. So if I go back and look at the first quarter results season, pretty much every company reported what we were looking for. If you go back to the Amazon side, I show you, Consensus had to upgrade their estimates on Amazon by 10%, yet the share price went down. So that's generally a sign to take a bit less risk. We're not really getting rewarded for taking risk. It won't, as I said earlier with Amazon, it won't last forever. Ultimately, the stock will follow its earnings at some point. So the first thing we've done is we've taken a little bit less risk. The second thing we have been doing this year is we did have put options on things like 10-year treasuries that added a little bit of value in the first few months of the year. And we do have, some short positions that we can put on bonds, for instance, that is a bit of a style hedge against a rotation. Those have been quite useful in the first half of the year. We could have made more money out of them had we been a bit more aggressive. It was really the first time we tried it, and it's definitely another tool that we've got for the future. The last thing, obviously, as I said earlier, that we've done is, we have, made some changes here with the digital enterprise area. So a couple of these areas, if for those of you who follow us quite closely, would know that we came into the year with digital enterprise as the number 1 area. And, we had a number of software companies and we had Microsoft, ServiceNow, Adobe. We also had things like Atlassian and Twilio. Some of these higher multiple names. Those are the ones that we've taken out of the fund, and we have pushed climate up because climate is where we can just find, just a lot more broader, more stimulus-focused companies, more recovery-focused companies that we like. So we have made some adjustments here to try and just lower the multiple or the overall multiple of the portfolio. And I think, we probably did go into the year a bit too wedded to some of our winners from last year. And so those changes we've definitely made in the last couple of months. So those are some things that we can deal with to deal with the rotation. The last thing I'd just say, though, really importantly, this is the performance of the fund over the last 5 years. And our goal here is really to focus on this double-digit number through the cycle. And that's effectively what we managed to achieve. And that's also what we've managed to achieve in the 10 years previously. And it's important to stress, as I said at the start, it's not a straight line. There are periods of flat performance here. The capital protection tools are really there to make sure we don't lose a lot of money in any one period. And I think we've proved those credentials over the COVID period where we actually made money in that March quarter. But it's important to stress that people should look at the fund on a 3 to 5 year view and really judge us on hitting that above double-digit return through the cycle, and judge us on doing it with a beta below the market, and judge us on doing it with upside and downside capture. And now in any 1 or 3 month or 6 month period, it's not gonna work out in a straight line. It's just not. We saw that back in 2019. We may see that for a 6 month. Well, we have seen that in the first 6 months of this year. But over the journey, it's important to stress that in the portfolio are a bunch of companies where we're reasonably confident their earnings are going to double in the next 5 years. And if those companies do, or a good chunk of them do, then their share prices are probably going to double over the next 5 years. And so that's ultimately going to drive us towards our 15% target. And if it's not happening in any 1 or 3 month period because everyone's focused on some macro event, that's great. Ultimately it just sets us up better for the second half of the year. And it's not dissimilar to stuff we've had to deal with in the last 5 years. And it's not dissimilar to stuff we've had to deal with in the last 10 years. It's just part of the process that is investing, I'm afraid.
No, look, makes sense. Now we've got a crypto question.
NAP. Haven't done one presentation in the last 12 months without one.
We wouldn't want to avoid it. With the cryptocurrency market recently surpassing 1.8 trillion, what's your stance on digital payments? And do you have any allocation to any cryptocurrency type stocks in the portfolio?
Thank you. Where's that going to take me? There we go. Okay, crypto sits within the digital payments area of interest. So we do not hold cryptocurrencies in the fund, and we probably won't. We wouldn't discourage you from doing it with a small portion of your assets. I can see the argument for people doing it. I can see why they're doing it. But definitely, wouldn't like any good investment, you should be diversified. And this is one you should be particularly diversified in. But from our point of view, we invest in companies run by humans who, generally founders that have great visions for great businesses. But the companies we are looking at, are moving into this space, and we think that's a smart thing to be doing. And so the reason why we think it is because, of all our digital penetration periods, the one that's about to go 100% penetrated is digital cash. So 10 years ago, I'd probably come into your office and say cash is going to disappear, and everyone would laugh at you. Now everyone can see that cash is going to disappear. And when it disappears, some cool things are going to happen. The first thing that's going to happen is, your fintechs, who've traditionally dominated sort of these sort of areas, are going to be able to move into all finance. So rather than just doing, things like buy now, pay later, or peer-to-peer payments, or e-commerce transactions, they're going to be able to move into, paying your bills, running your banking, etc. And so you've got this wonderful S-curve of opportunity where you've basically got, the biggest and laziest and most boringest companies on the planet being banks, who basically look like the next newspapers, because, there's roughly 10 to 12 in every country on the planet. And they basically are sitting there in these regions because that's where they used to collect cash. They used to collect cash, Bank of New South Wales, Bank of Melbourne, Bank West, etc. And so they collect cash in that one area because that's where you used to take the day's takings. Once that goes away, once cash disappears, there's really no reason to go to the bank. Now, I know you've moved on and you've got different relationships with them now, but there's no reason why the next generation should open up a BankWest account. They could easily just open up a PayPal account. And so from that point of view, the fintechs here, this is the revenues of the top 30 fintechs in the world. That's the revenues of the top 30 banks in the world. These guys are basically going to take share from these guys on an S-curve that's going to run for about 20 to 30 years. And these guys just get disrupted like the newspapers and television stations before them. And so from that point of view, crypto is just a part of that. So we like PayPal. PayPal is this classic app that people use that has all these other areas that they can move into. But you could say exactly the same thing for Square. And I could probably see the argument for Afterpay or something like that as well. So ultimately, you're using this app for one thing at the moment, and they can start to sell you all these other things. And crypto is one of them. And so just to finish on the crypto discussion, why do people like cryptos? because cryptos are really just doing the same thing. If there's no reason for all these banks in the world, there's really no reason for all these currencies in the world. The world needs a digital currency, whether that's a Bitcoin or a stable coin or some sort of digital payment that stops you having to lose all this money transferring currency from US dollars to Canadian dollars back to Australian dollars. And so PayPal and Square will be at the center of that, and that's why we like those ones the most. And that's sort of our way of playing crypto. We think this is definitely going to be a really exciting area in the future. I'm sure the investors have got their own way of playing it, but that's our way, which is PayPal. And we wouldn't put you off buying Square either. We're just trying to get it at the right price.
Okay, thanks, mate. Now I've got a question that takes us back to Moore's law and artificial intelligence. And basically, with the advancement of technology, will this actually cause a depression in wage inflation and potentially other issues around technology basically taking human jobs? What's the actual social and what are the implications for investors? Is it as simple as people just need to be retrained into new occupations? So this is sort of a broader question just around technology and the impact.
Yeah, I think it's a great question. So, I showed you the slide earlier. So this is the Moore's Law slide, but let me just, actually, I'll skip through this stuff and take you back to the main slide I was showing you earlier. Look, it is something that I think is very important. And the problem is not that technology innovation is a great thing because it's solving a lot of the world's problems. The question the gentleman's asking, or lady's asking, is the speed of the adoption. And so the speed of the adoption is causing these problems in the world because it's means wage inflation doesn't go up. It also means you have these network effects around these companies, which means, guys become not just rich, they become like mega rich. So Facebook, Google, Amazon exist. And so, Microsoft exists. And these companies, because they're digital, they win without borders, right? So Microsoft is the software company for the planet. Facebook is a social network for the planet. That never happened before. Before you just had, Walmart, which is the biggest supermarket in the US, or JP Morgan, which is the biggest bank in the US. You didn't have these global mega titans and all the money ended up going to just a handful of individuals. It's highly, highly inefficient because these guys obviously then spend the money on, generally charities or pet projects, etc. And so it's quite inefficient for the planet in terms of the money multiplier. It's very nice that they do it, but the money multiplier from it's not great. So that divergence between rich and poor gets worse, which is why, you see the central banks now really focusing on inclusiveness, focusing on a whole bunch of things to try and bring everybody along. And you can hearing this a lot from central banks at the moment. From our point of view, I think they realize that this isn't going to stop. So they realize that technological advancement will continue. They realize that if wage inflation did come back, that ultimately robots would come along and do it. And so that's why they're pushing so hard on the inflation side of things. And so I suppose that's the solution to what's happening. Nothing's going to be able to stop it from here, I'm afraid, because, entrepreneurship and capitalism make it happen. And so what they just need to focus on much more is how they rebalance the world, or how they bring everybody along, or how they redistribute wealth. And I think Joe Biden's got some smart plans here around taxing some of these rich individuals. And I also think this is why we love climate so much, because the climate becomes the solution to everything. Because in the end, the governments want to spend money, they want to employ people, they want to do infrastructure, and now they've got an excuse that they need to save the planet from impending doom 30 years from now. And so that's why climate becomes the solution to this problem. And so I think the barbell between our technology and our climate stocks really offsets each other quite well here. But it is obviously a trend that's been with us for a long time. It's a trend that's not going to stop. And I think from our point of view, I think the central bankers of the world understand this, as do the governments. But ultimately, it's a redistribution story that we need to focus on, because you do not want to stop the advancement. The advancement needs to keep continuing because that's the key issue in the world. Last thing I'd say here, super important. Sorry, because it's a great question. I love this talking about this stuff. This is why you got to own semiconductors. Semiconductors are they're the new oil. They are the shovels in this boom. They're the shovels in the boom between companies, and they're the shovels in the boom between countries. Semiconductors are at the core of this. And so your ability and your access to that technology is what's going to make one country more successful than another into the future. And that's why we love them so much, because, and you don't even have to pay for them. You know, TSMC is 22 times earnings with a 3% yield, and it's a monopoly. So from that point of view, we just really like that space.
Oh yeah, I love this story. Really, it's fascinating. Personally, myself as well, I find it really fascinating. Now I'm conscious of time. I just want to probably just touch quickly on TSMC actually themselves, and just around the geopolitical tensions between USA and China. I mean, it's a stock that's really wedged between these two great, powerful nations, and you know, what are the risks here, and what can you do to mitigate that? It's really quite a concerning sort of area. It's probably, you know, I've heard you often say like TSMC and ASML are two of the most important companies in the world that no one's ever heard of.
Yeah, so obviously the people who advance this Moore's law are the big winners here. That's ASML in lithography, TSMC in foundry, and NVIDIA in the US on chip design or accelerated computing. They're the big three in the portfolio. None of them are, you know, TSMC never gets over a 3% position. We always try to manage that country risk side of things. I think all the exposure, all the interest in Taiwan is just confirming what I said before. You know, we used to spend a whole bunch of time talking about the Middle East until we didn't need oil anymore, so we don't talk about it anymore. Now we spend a whole ton of time talking about Taiwan because we need leading edge semiconductors. And so the fact that it's getting talked about means it's not going to happen. It's just our way of bringing it to the attention to basically point out to the Chinese that, you know, don't Taiwan's sitting there like Switzerland supplying semiconductors to both China and the US. And so the US are basically saying, don't touch Taiwan. The US have worked out they've got a security of supply problem. They're now trying to build foundries onshore in the US, but it's going to take roughly a decade to solve. But all it is just telling you that we're actually invested in the right place, because these companies are actually incredibly important. Yes, there's a small tail risk that something could go wrong, but we just manage that by diversifying the portfolio.
No, that's great. Well, I think we'll end it all there. We've clocked just over an hour, so if you'd like to just do a quick summary, and we'll bid everyone farewell. Yeah, so look, thank you very much for dialing in, and sorry that we can't be there. I do enjoy my trips to Perth immensely. From our point of view, we do update the website with these videos, and you can subscribe to our YouTube channel. Highly encourage you to do it. The reason why, and as you know, we're very transparent with a lot of our ideas. The reason why we do it is because, you know, we understand that, you know, growth investing is a journey that you're coming on with us. And we want you to understand what we're trying to do and how we're trying to do it. And if you do that, then, you know, that helps you explain to your clients when things can be a bit slow like they are right now. But ultimately just to encourage you to stay for the journey on the 3 to 5 years, because if you understand what we're trying to do, then we can just go and do what we need to do. And so it helps us perform better over time. And so please use these resources. We spend a lot of time on them, and they're basically explaining things like this, and don't be afraid to use it with your clients. And if you're not getting access to them, please reach out and let us know. But otherwise, thanks very much for watching. No, thanks everyone. And as you know, all know, you know me, you've got my contact details. So if there's anything you need, please feel free to reach out. We've got some great videos actually on the way for you very soon. So I hope you and your clients can enjoy those. So any more feedback or any sort of questions that come from this, please flick them through, and we look forward to catching up with you very soon. Okay, bye-bye.